Hi Parag, this is Arjun. You're joining in, right? Okay, perfect. Thanks. Hi Parag, thanks for joining in.
Hi. Hi, Sandy.
Hi, Parag. Hi. Hi, everyone. Hi, Abhishek.
Hi, Sandy.
We'll just get started shortly,
Yeah,
Sandy.
sure.
Okay, we are 2 minutes into the hour. Good afternoon, everyone. We are going to get started. I'm Arunabha Ghosh. I'm the CEO of the Council on Energy, Environment and Water. I'm very pleased to welcome you to this joint session between CEW's Center for Energy Finance and the International Energy Agency, at which we'll be releasing our latest edition of the Clean Energy Investment Trends Report for 2020. To achieve India's clean energy ambitions, policymakers on one hand, industry actors, of course, investors who put their money where our mouths are, and others and regulators, etc., must actually act in concert. That's easily said. But the problem is that for the clean energy investments to scale, we need to make sure that the responsiveness on policy on one side to what the market wants, and the market on the other side in terms of what the policy is indicating, is happening not just in concert, but almost in real time. Because unless we feel that dynamism, the overall macro story remains rosy, but not maybe a brilliant red. Now, here's the challenge. By monitoring market activity and identifying market financing trends, the Clean Energy Investment Trends Project, which CEW, Center for Energy Finance, and the International Energy Agency have been doing for the last 3 years, gives you that really insightful understanding of how those interactions between risk and regulations are shaping investment flows. But the challenge is that we are not scaling up as fast as at least I would like it. So the good news is that in the middle of the pandemic, when it was at its peak, when the country was entirely at lockdown, India sanctioned about 12 gigawatts of utility scale renewable projects. This, of course, included an option to exercise the ability to scale up and expand the allocations that were made to 2 developers in June 2020 under an auction that was held in December last year. And in fact, over the first half of 2020, about 15.3 gigawatts of renewable energy projects were awarded in India, which is comparable to the first half of 2019, which was 15.7 gigawatts. For me, that's fair enough news, because the pace at which we need to invest in renewable energy capacity, both to meet India's energy needs, but also to transition towards an overall cleaner energy system, is definitely much greater than what we are achieving thus far. And that's why understanding these dynamics is very important, that while we pat ourselves on the back, that renewables is a success story in the locked down Indian economy, we should not become sanguine with these partial successes. The financial performance expectations are crucial even in the economic downturn, as investment has curbed around the world. The resilience of the renewable energy sector sends out some signals. Now, how do we tap into those signals? How do we ensure that that momentum is not lost? To shed light on some of these issues, the Clean Energy Investment Trends 2020 report examines the appeal of utility scale solar photovoltaics and onshore wind in India by analyzing the project level expected equity returns over projects sanctioned in 2019 and in the first half of 2020. The report also examines key sensitivities of realized returns to risks such as the payment delays from distribution companies, volume risk, the lower volumes dispatched due to the factors such as curtailment or simply low electricity demand. The report also contextualizes the challenges in attracting capital stemming from issues related to policy uncertainty, the financial health of distribution companies, demand risk, land-related constraints. But that's not a 2020 story. That's not a pandemic story. That's something that has been long running, and we need to make sure that we don't take our chronic problems and hide behind the acuteness of the current crisis. We're going to have an excellent session, I can tell you in advance, because of both the content of the report and the caliber of the people assembled here today. Immediately after me, you'll hear from Tim Gold, the head of Energy Supply and Investment Outlooks Division at the International Energy Agency. Tim, thank you for your continued partnership on a range of issues on which we work together. But then we'll get into the meat of it. You will get the briefing presentation on the report from Lucila Arbolea, the Energy Economics and Financial Analyst at IEA, and Pablo Gonzalez, Investment Analyst at the IEA. And subsequently, we will have a panel discussion with Amit Jain from the World Bank, Parag Sharma, the founder and CEO of O2 Power, Sandy Khera, country manager and CEO of Enel Green Power India, Abhishek Goel, Principal Global Infrastructure Partners India, Shreya Jay, Special Correspondent of the Business Standard, and the moderator will be my colleague Arjun Dutt. We'll finally hear from my colleague Kanika Chawla and our collaborator Michael Waldron from the IEA as we close out the session. So that's enough from me, but I just wanted to bring to attention once again that while renewables is that rosy story in a very bleak year, that's not a baseline or a benchmark that we should be comparing ourselves against. How do we get that 12 or 15 gigawatts of sanctioning up to 20 and then to 25 out to 30? And that's what I hope that this partnership between CEW and IEA will continue to lend the right insights that policymakers, developers, and the financiers who put their money where our mouths are would follow. So thank you so much for joining us today, and over to you, Tim, for your welcome remarks. Thank you again.
Well, thank you very much, Arnab. Greetings from the International Energy Agency, from our colleagues here. Just to underline how much we welcome the collaboration with the Center for Energy Finance and with the CEW as a whole. Extremely grateful for this collaboration that we have, and likewise to our very distinguished group of panelists who have assembled today to discuss the report. This is the third edition of our joint report. The analysis gets deeper every year. I think it gets better every year. And we've got some really rich and innovative elements this time around that I hope we'll be getting into in the discussion. Many of you will be aware that at a sort of political level, the IEA is very much engaged with India on a new strategic partnership. But to me, what we're doing today, what we do with CEW, very living representation of that kind of engagement in action. We're working together on extremely strategic issues in a spirit of close partnership. I'm extremely grateful for the trust that we have at all levels with CEW. And I think that's a tribute to the expertise that Aranaba has assembled, but also that open, kind of forward-looking atmosphere that we sense every time we engage with the center. Since we last spoke a few months ago when we released our World Energy Investment Report jointly with you, we've also released our new World Energy Outlook. I hope that you've noticed that the sort of investment financing angle in the outlook has been getting steadily stronger in recent years. That's no coincidence. That's due to the arrival in our team of Mike Waldron, Lucila Abelea, Pablo Gonzalez, the other colleagues who you'll hear from today, who've really enriched that angle of the work as well. As you can imagine, a key theme for our outlook this year is the disruption from the pandemic. Just 2 points to mention on that. The first is that, that disruption changes many things, but it doesn't change the key central importance of India to the global energy outlook. And the second headline conclusion, and this very much echoes what Aranaba's just said, is all about the sort of resilience of renewables, how clean energy technologies have, in a sense, been hit less than fossil fuels by the disruption of 2020. That's certainly true. That's visible in our own analysis. But I completely agree that we shouldn't start celebrating that. We need to go faster. And that's why I think this kind of analysis of the risks, of the disruptions, of the financial position of discoms, the investment flows, it's extremely important. Policymakers, industry, everyone needs to keep their eye on the ball. Awareness of these new layers of risk to clean energy project planning and execution. So very much welcome today's conversation. It's extremely valuable also to us as we work on our next major piece of analysis, which will be the India Energy Outlook that we'll be releasing early next year. So I'll be listening very attentively to our discussion today. Once again, many thanks for your participation. And I think now I pass the floor across to my colleague, Lucila Abelea, for the presentation.
Thank you, Tim. So I think I'll be sort of quick with the first slides because much of what we wanted to say has been said, but maybe two things to point out. First, the fact that we are analyzing here utility-scale solar PV and onshore wind projects, all competitively tendered. And second, that the period of analysis that we focus on in this third edition of the Trends Report is the year 2019 and the first half of 2020. And maybe just to zoom out, but sort of echoing what has been said by Tim and Arunaba, we had seen capital spending of renewable power up by almost 60% in the last 5 years through 2019. But of course, there was a big shock in 2020 that happened across the world and across the energy sector, but also in the case of India. But pointing out the same thing as what Tim and Arunaba were saying, that even when we looked at capital spending in 2019, investment was falling short already. In fact, when we compare the 2019 investment with the medium-term investments in the stated policy scenario, the IEA scenario that reflects all of today's announced policies, intentions and targets, the 2019 level would have to almost twice, increase by almost twice to get to those average stated policy level investments. And in fact, when we compare with the sustainable development scenario of the IEA, which is compliant with the Paris Agreement, but also includes energy access and air quality goals, the 2019 levels would have to more than double. But still, as Arunaba was saying, interest to invest, and this we're depicting this by looking at sanctioning of projects, was relatively resilient in 2020. And the relative term here is very important because sanctioning of solar PV capacity has performed considerably better than wind. And again, part of this has been, I mean, it's worth noting, as you can see in the blurry piece of the third yellow bar on the left, part of this was a story of those 8 gigawatts that Arunaba mentioned. But even when excluding those, we see that sanctioning in the first half of 2020 was slightly higher than the first half of 2019. And as Arunava said, this is fair enough news. But that's even the case of solar. In the case of wind, there was actually no sanction capacity in the first half of 2020. And we'll touch upon some of the specific risks later on. And very much in line with what I said before and what Tim and Arunava were saying, still also an important thing is that reaching the ambitious renewable targets of India would require increasing the pace of installment to levels much higher than the ones we've seen. So before moving into the financing costs, which were very important, of course, and big drivers of investments, let me mention two landscape indicators that we also looked at. First, the level of concentration among developers in the market. We looked at this in the report and we find that concentration remained high in 2019 at around 80% for both solar PV and wind. This means that around 80% of the sanctioned capacity, or even higher at some points, was awarded to the top 10 companies. This likely reflects the higher risk-taking capacity of top developers and their better ability to navigate policy and regulatory uncertainties. And it will be very interesting to hear about the panelists on this. And then a second point is that project sanctioning has also shifted strongly towards projects tendered by central government off-takers over 2019 and the first half of 2020 in the case of solar. And there may be a dual causality here. On one hand, developers choosing central tenders because these have lower perceived risks. And on the other hand, greater capacity being tendered by central government entities as it is in these tenders where lower tariffs are discovered compared to those of auctions run by state governments. And then moving into the sources of finance and financing costs, let me mention two things about debt and then we'll move to the equity side of things that Pablo will talk about. So the first thing is that we found that projects continue to be financed with high shares of debt, around 75% on average. This is similar to what we see in other parts of the world for solar and wind utility scale projects, and also for longer periods. When we compare the duration of the loans provided to solar PV and wind projects in the last years, these were at around 16 to 18 on average years of duration, compared to 14 to 16 5 years ago. So there's an increase of about 2 years, which is very good given the long life of these projects. And in terms of the actual cost of the debt, the interest rates of these loans were on average at around 10-11%. And in line with efficient market theory, what we would expect is that, in fact, and what we see happening in the market is that differences in the cost of debt vary due to off-taker risk. So where perceived risks were higher, so were interest rates. And this is, for example, what we see in the yellow bars. And in fact, when we compare, the yellow bars are showing the interest rates or the increase, the premium to the interest rates for projects that are outside solar parks, so projects where developers need to get the land, and when the off-taker is central versus when the off-taker is a state discom, for example, Uttar Pradesh, we see that the difference between those two off-takers is around 50 basis points. So this is how the off-taker risk is priced in the case of debt. And the 50 basis points in a very competitive industry, it's an important piece because, as I'm sure the panelists would agree, every point matters. So then I'll pass it on to Pablo to discuss on the equity piece of the investment.
Thank you very much, Lucila. I will follow by presenting you the analysis that we did on expected equity IRRs. So how did we do it? We had awarded tariffs, estimated project costs, production parameters, and indicative terms of debt. By reverse engineering all this input data through a discounted cash flow analysis, we can calculate the expected equity IRRs. And this is the result that you can see in the figure. There is a reasonable dispersion from one project to another, but average expected equity IRRs are at levels of around 15% on average. This is around 1.4 times the cost of debt financing. Estimated equity IRRs varies depending on the type of project and the off-taker, but there is also a temporal effect that I will discuss in the following slides. But first, I would like to show you one of the main insights from the report. Competition within tenders was an important determinant of returns expectations. As you can see, tenders characterized by lesser competition were associated with higher equity IRRs, while those marked by greater competition yielded average lower equity IRRs. And for your information, we have measured the level of competition as the ratio of capacity bid to capacity tendered. If bids are lower than the tendered capacity, competition will be low. Whereas if the number of capacity bid is twice or more the tendered capacity, we would be in a high competition case. We have used this indicator, the level of competition, to assess the temporal evolution of expected equity IRRs. In the first half of 2019, you can see it there in the graph, tenders attracted quite a lot of interest and competition was high, with bids outspacing tendered capacity. In this environment, expected equity IRRs were more or less moderate at levels of around 14%. However, during the second half of the year through mid-2020, expected equity IRRs rose around 200 basis points to 16–17%. This rise can be explained by higher policy and market uncertainty. This uncertainty increased due to factors such as potential renegotiation of contracts by discoms or the imposition of or extension of duties on solar PV imports. The situation was further exacerbated by supply chain uncertainties caused by COVID-19 and delays in the signing of PPAs in 2020. However, we have seen increased interest again in the first half of 2020, maybe due to higher innovation in tenders or measures such as granting letters of credit. As you saw before, the dispersion in expected equity IRRs for solar project is high. This is why, to gain insights on the type of project and the off-taker, we compare projects awarded closely spaced in time. And this means in the same month or a month close in between projects. This allowed us to examine returns expectations under the same policy, regulatory, and market conditions, ensuring that these factors do not color the comparisons. On the left-hand side, you can see that projects with the most credit-worthy off-takers, central government off-takers, had the lowest equity IRRs, and that credit-worthy state discoms, such as those in Gujarat, which would be the point in yellow, had similar return expectations. By contrast, less credit-worthy states showed higher equity IRR expectations at around 80 to 200 basis points. On the right-hand side, you will notice that projects to be installed in solar parks had lower equity IRR expectations at around 20 to 260 basis points lower than those for comparable non-solar parks. This is because solar parks offer assured land and evacuation infrastructure, and this helps to manage land acquisition and transmission risks. We have focused so far on expected equity IRRs for developers. However, once a project is built and in operation, further risks might arise that can harm actual realized returns. We present you here two probable risks that might arise: payment delays and volume risk. The sensitivity analysis on payment delays is on your left-hand side, and it depends on two factors. On the x-axis, you can see the average delay in payments, 0, 3, 6, 9, or 12 months. But you can also see three curves in different colors, which corresponds to the number of years for which this delay persists over the life of the contract. So for instance, an average 3-month delay that will occur during 5 years lowers the realized equity IRR by 80 basis points. Whereas in the most extreme case, a 12-month delay that persists for the whole duration of the contract would lower the equity IRR by around 500 basis points. On the right-hand side, we present you the sensitivity to volume risk. Volume risk can come from diverse sources: curtailment, low electricity demand, underperformance of technology, faulty operation and maintenance, or meteorological variations. But curtailment risk seems to be of the greatest concern among investors. You will see that using the same methodology as in payment delays, the equity IRR for solar PV projects would be impacted by around 70 basis points per every 2.5% of total production lost in the first 5 years. This would grow to 160 basis points if you lose the same volume every year. My last slide presents an important insight of this report. The timely availability of suitable sites for setting up renewable projects is emerging as a critical challenge for India's energy transition, with evidence for both solar and wind deployment. As you can see in the figure, land-related constraints have reduced the share of projects located in solar parks in overall capacity awarded from 2017 onwards. This trend is even more dramatic in wind, where sanctioned capacity declined from 6.9 gigas in 2018 to 2.9 gigas in 2019 and zero in the first half of 2020. Changes in land policies for renewable projects in Gujarat is one of the main factors under this problem. So to sum up, we can conclude that central entities are the ones preferred as off-takers, project debt finance has remained stable, expected equity IRRs vary depending on the type of project and the off-taker, market concentration of developers has remained high, the timely availability of sites is an important challenge, payment delays and volume risk might undermine realized returns, and tender design is evolving in response to emerging challenge. So thank you very much. We will finish the presentation here, and I give the floor to Arjun and to the panelist discussion. Thank you.
Just a marketing point before Arjun, these slides and the report are available online and free to download.
Thank you, Lucilla, and I will just share the link to the report and the slide deck with everybody for everybody's benefit. Should be there in your chat now. All right. Hello, everyone, and a good day to you wherever you are in the world. I think it's only fitting that even the speakers in today's webinar taken together are joining in from 3 different continents. The energy transition is truly global after all. Of course, today's focus is the evolving landscape of renewable energy investments in India. I'd like to thank my co-authors, Lucilla and Pablo, for setting the context by very elegantly summarizing the key insights from the Clean Energy Investment Trends 2020. These data-driven insights on market and financing trends ultimately serve as markers that indicate whether India is on the right trajectory to meet its clean energy ambitions, or if course corrections are needed along the way. To discuss these very matters, I'm honored to moderate a most distinguished and diverse panel for today's deliberations. We have with us an experienced equity investor in renewable energy platforms, and Abhishek Goyal from Global Infrastructure Partners, seasoned developers in Sandy Khera from Enel Green India, and Parag Sharma from O2 Power. We have sectoral experts in Dr. Amit Jain of the World Bank, and a nuanced sectoral commentator in Shreya Jay of Business Standard. Welcome to all of you. Before we begin, for everyone attending, please feel free to use the Q&A function to send in your questions or thoughts or comments along the way, and we'll try and pick on these themes during the discussion. With that, okay, let's get today's conversation started. So Lucilla and Pablo in their presentation alluded to the fact that the interest to invest in the Indian renewables market is fairly robust, even in 2020, a year when there's been an unprecedented disruption in both the global as well as the Indian economy. So Sandy and Parag, since both of you represent companies that have been very active in the Indian RE market over the course of 2019 and 2020, I'm going to start with the two of you. So why is the Indian RE market so attractive to investors? Is it the attractiveness of renewables as an asset class, or does India offer something more to investors compared to other geographies? Sandy, let's start with you maybe, and then we'll come to Parag next.
Yeah. Thanks, Arjun, and thank you everyone for this opportunity. Yeah, so to answer your question, as Arunabha had said at the beginning of the discussion, the macros are compelling, very compelling. I mean, India is looking at growing into a huge manufacturing and industrial hub. The growing urbanization, rising incomes, increasing population will only increase the demand for electricity, right? And if we have to become a $5 trillion economy, as the aspirations are, we need electricity. And from an economic standpoint, and also from a climate and environment standpoint as well, we can't afford to go down the traditional fossil fuel growth path. Right? More importantly, now India offers one of the largest clean energy development programs in the world. The plans to grow to 450 gigawatts are ambitious, but nevertheless, it does offer a huge opportunity. And the tendering and tariff system is quite transparent and offers a a very efficient return on investment platform for people to participate in. And then, as the Prime Minister said yesterday in his address to global investors, I mean, if you're looking at demand and democracy, if you're looking at stability and sustainability, India is the market to look at, right? So politically, the political stability and intent of the central government does add to that investor confidence as well. And as far as the renewable energy sector is concerned, it's quite mature to an extent that there is low risk, the project sizes are large, and the sector has come a long way from the earlier 10 years ago period of the renewable energy being a tax saving asset class to now being a standalone viable industry in itself. And as far as NL is concerned, I mean, the sheer size, scale of opportunity and the visibility of the pipeline offers us huge opportunities and gives us a chance to leverage our technical expertise, provide the cost-effective solutions that we're looking at, and also deliver on our global commitments to sustainability, decarbonization, and climate change. Yeah.
Fair points, Sandy. And I think you've captured the macroeconomic landscape and the opportunity that presents, and also the sectoral developments in terms of the project pipeline and the policy and market environment that India offers. Parag, of course, O2 also started investing in earnest in 2020 itself, right, in a very, very challenging year. So from your perspective, to add to what Sandy mentioned, what prompted you to take the plunge in this challenging environment?
Yeah, thanks, Arjun. So most of the points are already covered by Sandy. And as Sandy said, if you ask any private equity player in the world, he's looking for renewable sector, first of all. And within the renewable sector, if there is a market which provides size and a good combination of size and the IRRs, then it is an Indian market. As you see in India, most of the incremental demand of India is going to be met by renewables. In fact, now MOP has announced that it could be decommissioning around 25 gigawatt of coal-based plants. So leave about the incremental demand coming from renewables, even there will be a slowly replacement of coal-based plants by renewables. So that would be a further fillip to the renewable sector in India. And I think the third element is that the competitiveness of the solar sector in India at a world scale is very high. We have a great combination in Rajasthan of good radiation and a very cheap land. So that really adds to the competition or the competitiveness of the solar sector in India. We lag a bit as far as wind is concerned. And that's how you see today, there is a 60 to 70 paisa difference between at the same IRR, the cost of production of solar versus wind, and solar is slowly taking over the wind in that background. So I think what our investors really looked in is that there is, as Sandy also said, very fair way of calling the bids. And it's not just, it has happened over the last 1 or 2 years. In fact, from the start of the solar industry in India, there have been a competitive bidding. And as far as wind is concerned, we moved to competitive bidding 3-4 years back. So both the sectors are pretty matured and have been developed in a very competitive environment. So that is one. And secondly, the onus goes to the entities like MNRE and SECI who have developed the bidding documents and made it very, very bankable. So if you see every 6 months, we see an amendment in the bidding documents, and it captures most of the problems that industry is facing. The change in law clause, the whole pass-through mechanism, the termination clauses, the deemed generation provisions. So the issues goes on and on. Every sector, every country has its own issues, but the ability of the government to sort out these issues and improve the bidding documents is really creditworthy. And the last thing is that the problem of distribution companies not being able to pay, that also has been resolved in India. And for entities like us, we are just focusing on central government bids where off-takers are all AAA rated. So that's, I would say, is which interested us in the sector in India.
All right. Thank you, Parag. And in fact, I mean, your points are all, I mean, well taken in terms of the market and policy design that has enabled such investments to flow. But in your remarks, you also touched upon, certain limitations. Of course, while, it is the interest to invest remains strong, India's clean energy ambitions demand even greater level of investments. So, for example, the annual capacity sanctioned that Lucilla and Arunabha mentioned are around the range of 15 gigawatts that was achieved in 2019. But if India is to meet its 450 gigawatt target by 2030, we probably need to double that number at least. So, Amit, I'll probably come to you next. And I'm going to ask you to lean on your extensive experience in India's RE sector to help structure today's discussion. So, of course, Sandy and Parag have mentioned good things about the Indian market, but towards the end, Parag also touched upon some areas that need improvement. What I'm going to ask you to do is please think about, lean on your extensive experience, and for us, contextualize and prioritize the major risks that need to be addressed for India to realize higher levels of investment in line with its ambitions. And then we can, pick on each of these risks and take the discussion forward.
Thank you, Arjun. Not only Sandy and Parag, but Tim, Lucilla, Arunabha, everybody is very bullish about the Indian renewable energy sector. But let's take a step back before I answer your question and try to decode and set a baseline for today's discussion and my comments. The title of the seminar today is Evolving Landscape of RE Investments. So we are looking at future. What is the future of investments coming in India based on experience? But we are not talking about present, we are more talking about the future. Now, Tim mentioned that disruptions caused by the COVID to RE has been minimal. I would a little bit beg to differ that long term, yes, India remains a mature market, but for short term and medium term, in 2 to 5 years, COVID has given a shock to the renewable energy sector much more than the thermal sector. See, the thermal sector has long term PPAs. Even if the PLF goes down to 30-40%, they still get 2 to 3, 4 rupees per unit. RE sector is today facing curtailment, and we have some significant problems, which I will describe sometime later. Then Arunabha mentioned that lenders and equity providers are the best people to tell what is happening to their investment. So while Sandy and Parag has given a very positive picture about the future, I would try to be a little bit of a devil's advocate that being the World Bank, we have $2 billion riding in the market. I have a little bit concerns about the short-term and medium-term evolving landscape of investments coming in India. Then Lucilla mentioned in her presentation a 17% decrease in 2019 or 2020 with respect to power investments. She also mentioned in her slide that the sanctioned projects, the focus has been on the sanctioned projects in the report. See, Arjun, when we talk about 450 gigawatts or 100 gigawatts, we are not talking about how much sanction the government is doing or India is doing. We are talking about operation, construction, and projects who are developing and generating electrons. We claim, and the claim is true, in the last 6 to 9 months, India has sanctioned 20 gigawatts of the projects. That's a cause of concern. Why? 14.8 gigawatts of these projects, and many of them by central entities, by SECI and NTPC, PSAs have not been signed. And more than, and I'm not talking about here delayed payments. I'm not coming to off-take a risk. I'm talking about back-to-back PSAs have not been signed. 2 years back, Arjun, when we used to have these seminars, the discussion of topic was 2 years back, the state bids, state PPAs are not as bankable as the SECI and NTPC, So SECI and NTPC used to be over here, the landmark, where the international investment, CDPQ, RDR, okay, SECI, NTPC, come, we'll bid. Now we have a challenge for these bids. I can tell you exact bids in Punjab, in Uttar Pradesh, in Tamil Nadu, and these are SECI and NTPC bid, which international investments, they have shed these PPAs because the PSAs has not been signed for the last 12 years. So we have a serious problem. 14.8 gigawatt is the official figure, which has come in media, but 20 gigawatt is a real number where SECI and NTPC is not able to sign PPAs. So that's why I say I would like to break a myth over here that renewable energy has not been or even marginally hit by COVID. It is not true. We are terribly hit by it's a shock. And the shock is not artificial, Arjun. It is the basic problem of a power structure. See, as you know, power procurement in India is a loss-making proposition, right? Discoms buy power, doesn't matter 2 rupees, 3 rupees, 4 rupees. But when they provide to rural areas, they shed power because they make loss. When they provide to farmers, they provide to residential activities, right? So we artificially, as a country, we announce that we are a power surplus nation, which we are not, because we are shedding. The demand has gone down, and on top of that, we are shedding. So we have created this bubble of being the power surplus. Secondly, because of COVID, the C&I customers, the commercial and industrial customers, which were the cash cows of discoms, have stopped working, right? So discoms are in even more trouble what they were 3-4 years back. How can we ask them or force them to buy even a 3 rupee solar power? So their problem is genuine. So the reality on the ground, Arjun, is today discoms said, we will not buy a 2.66 rupee power. So forget about the peaking power, the RTC, all the other innovations India has done. None of that thing PSs have been signed. So we are yet to see the innovations we have done, and they are great innovations when they get constructed and being installed on the ground in the next course of site. Again, I completely agree with Lucilla when she mentioned about 15% IRRs, off-taker. This is all fine, but last 6 to 9 months and next 2 to 3 years are going to be challenges. Very quickly, 3 solutions I'll propose. First, Reva Solar Park, where a 3-tier mechanism was done, where a state government guarantee or, for example, a World Bank guarantee, a funded ESCOM mechanism, and a letter of credit. So three things could be structured when a PPA is being sold in the market. Second, because 2.66 or whatever number has now come in the discoms on market, a bundling of the thermal and the renewable energy products is possible and should be done. See, in the whole country, we should have only one PPA for discom. It doesn't matter what PPA you have in the market, but for discom, we should have one PPA where the government of India should bundle in the background and sell that PPA to discom. It doesn't matter it is a state bid or a central bid. And finally, we know that, as I think Tim was mentioning, that Gujarat and Rajasthan are going to have 60 gigawatt of PPAs of solar and wind, desert and free land. Where will you transfer? Where will you consume this 60 gigawatt of bid? Either you take it to Delhi, either you take it to Maharashtra. These are the demand centers. Or let me propose one more thing to you. Can we have an undersea cable to Gulf where we can transfer this 60 gigawatts under the One Sun, One World, One Grid initiative? So these are the innovations which we need to start thinking today so that we can start implementing them 3 to 4 years down the line. Thank you, Arjun.
Thank you, Amit. And let me tell you, we like having devil's advocates on our panels because it makes for very interesting discussions. But I think you've made my job easier because you've talked about a whole wide range of issues, and we can try, you've covered a lot of ground. So we're going to try and start, picking on some of these points that you've mentioned. You did talk about the discoms, and ultimately that has long been the bane of, India's power sector and particularly renewable. So maybe we should get started with trying to see what we can do in that regard. So Abhishek, maybe I'll come to you. And of course, Amit has already spoken about try to contextualize the challenges with the discoms. And of course, recently, I think earlier this year, the government tried to bail out some of these discoms by providing a liquidity infusion through loans from PFC and REC. But of course, though this provides some short-term immediate relief, this may not necessarily address the longer-term off-taker risks. So from your perspective, as an equity investor in RE companies, what do you see as credible measures to address this off-taker risk?
Thank you, Arjun. And so far, the panel discussion has been extremely interesting for me. And I was in particular interested with Amit's views, which is quite insightful actually, and do indicate the on-the-ground realities. So But as investors, I mean, firstly, GIP has investments in renewable assets across the world and as well in India. What we see is that, I mean, either we say that that renewable is not a sector for an investor to invest in, right? And think about other sectors like roads, ports, airports, whatever. But if you are saying that renewable is a sector of interest, then in each and every sector there are issues. Now we have to identify as investors which sector has lesser issues, which sector the issues are manageable, and which sectors you have the support of the government. So all these three boxes, I think, are ticked for renewables in India, which is why we remain very interested in renewables in India. Now, the Sandy and Parag mentioned about why, as developers and investors, they are interested in the renewable sector. I'll just add one more point to that before I get to your point, Arjun. So the government in India, apart from various issues that they've been facing with the state governments, the central government at least has been walking the talk, and during the COVID period, so many issues happened, but at the same time, the government fully backed the private renewable developers. At one point of time, the state discoms were calling force majeure, and the force majeure not only said that we will not offtake power, they said that we will not pay, and even not pay for the power that was already supplied to them. That's the level of force majeure that various state governments had asked for. And that was like really terrible for all the developers, because if you don't get paid, then you can't service your loans. And they said that, okay, you can go for a moratorium from the lenders, and the entire domino effect would have started. But the MNRE stepped in a very positive way, and it's told each and every discom that you can't call a force majeure, and many people did not. And that is what, allowed the cash flows to developers to keep coming. And that's why we were able to, remain committed and remain, able to meet our obligations. At the same time, the government also, in many cases, assured must-run status. There were some curtailments in June and July, but after that, once the demand started picking up, the curtailments, if you see, between the thermal sector and in the renewable sector, the thermal sector curtailments were much more than renewables. So renewables was given the kind of importance that is supposed to be given to them in terms of the must-run status. So I would say I remain fairly happy with the central government that they have been walking the talk and supporting the private developers in the growth and the development of this space. So having said that, what more can be done? Arjun, to your point, what are the levers that we need to put in so as to continue to grow towards what our aspirations are as a country? We've talked about many things, and I'll just draw upon some of Amit's points also here. Amit, with your permission, Amit talked about the PSAs are not getting signed. Absolutely right. PSAs are not getting signed, and that's a struggle for many of the private developers. There is containment. Lenders are not very happy. Lending to renewable projects, especially the state government projects. So all of this comes to the kind of risk that is perceived when you're dealing with state discoms, right? The PSA is not getting signed. SECI, NTPC are running behind state discoms. They are not signing the PPAs, right? State governments are delaying payment. That's why the banks are having a bad experience. So they are not happy lending to state PPAs anymore. Now, why is all that happening? Now, the central government has infused 90,000 crores of liquidity through PFC-RSE, which they can take. But several states, and I won't name the states, they want 6% interest, and they are negotiating on interest. I mean, on one hand, you've got so many large overdues that you are logically supposed to pay to developers. On the other hand, you're negotiating on interest and this unnecessarily delaying, and the time that you're losing, the LPS or the late payment surcharge on that time lost is much more than the interest that you're trying to negotiate. I mean, a kind of a logjam is created where the state discoms objectives and the central government's objectives are not aligned. Okay. Now, for whatever reason, as long as those misalignments continue, there will always be a tussle with, and I would say, central government and the developers on one side, and the state discoms, who are the actual users of power, right? They are the actual users. They have to take care of the farmers and the users of power on the other side. So what can be done to remove this misalignment? What can be done to ensure that people are actually following what they're supposed to follow? Like a contract, a contract, let's say 6 years back when the solar power was 8 rupees, okay? 8 rupee power, you have a contract, you have a PPA, and that PPA is for 25 years. Now, today, when the solar power is at 1/4 the price, the discom doesn't want to honor that, right? But at that point of time, they did enter into the contract, and following the contract is something of it's like a holy grail, right? I mean, you cannot renege on a contract unless you can prove that there was some wrongdoing at the time when the contract was signed. You cannot renege on your contract. I mean, you can buy cheaper, but that's like buyer's curse, right? I mean, you buy something and tomorrow the price falls, you can't say I'm not buying. So the contract enforcement, which is what is very strongly talked about in the Electricity Act amendment as well, is one of the important things that has to be put in place. The second thing is the discoms are suffering. They are having, they are shedding, like Amit was mentioning, they're shedding, and they have to be supported. And who will support them? I mean, the governments, the central government's budgetary grants, GST refunds, all of those are delayed so much that the state discom is a guy who is not able to make ends meet, and you're telling him to pay 8 rupees to a solar developer. I mean, how will they do that? So streamlining of these processes so that at least there is some liquidity, and there's some much needed liquidity that has been put in the system of 90,000 crores. But these kind of liquidity schemes have to be available so that the discoms can manage their own cash flows. And if they're able to manage their cash flows, then obviously it's very obvious to everybody that India is a place where the law is upheld and people will follow contract. So just the very fundamental problem on that I'm trying to refer to. So I'll stop there.
Thanks, Abhishek. And I think you've covered much ground, but I think interestingly, you also mentioned, of course, there is the underlying financials of the discoms themselves are a concern. And of course, there are some very fundamental reasons behind that. But you also extensively talked about what is essentially a governance problem, the sanctity of contracts being problematic. And that also, of course, from the perspective of investors, dampens investor confidence. So maybe, Shreya, I'll come to you next. As a nuanced observer and commentator on India's power sector as well as renewables, you've extensively, I think, written about and talked about some of these challenges. And do you think, and Abhishek mentioned the Electricity Act amendment, so do you think that these emerging policy measures, existing or emerging policy measures, are they sufficient to change the state of play in terms of governance of the sector, in terms of better enforcement of contracts, and some of these other challenges? So your take on this.
Thanks, Andrew. There are a lot of policy measures that everyone talked about, Amit and Abhishek both. I think when we look at these policy changes, be it the amendments to the Electricity Act or the bidding documents that SECI comes out with, I think in silos, they look very good. If we were to have a contract enforcement authority, something like Andhra Pradesh will never happen again. That is good in itself. If we look at the bidding documents which SECI prepares for renewable energy projects, are just brilliant, and the kind of projects that NTPC offers. So they're pretty good in themselves. But if you take a bird's eye view of the sector, is there a long-term framework for this sector? Has there been a end-to-end legislative support to the renewable energy sector till yet in India? I don't think so. We have been talking about gigawatts. From 175 gigawatt, we are talking about 450 gigawatt. But is there any legislative support? Are the discoms penalized for not meeting their RPO? No, they are not. Is there a comprehensive transmission system that is being planned along with the generation that is coming up? I do not think so. And are the state agencies, which is a major contention point here, which everyone discussed, have they been taken into account when we are talking about these large targets? Because in the end, these are the states who will buy renewable. And Abhishek mentioned that in the past 8 months or so, while the sector was facing the brunt of COVID, center was with the project developers against the state. I beg to differ on that. If you look at the policies that have come up in the renewable energy sector, they usually follow the market forces. A group asks for import duty on imported content, and then a duty comes up. Then a group asks there should be a safeguard duty, then that comes up. Then some project developers ask that there should not be duty, the rates will go up, the government changes its stand. So I think there is a lack of clarity, and I'd say the better word is a lack of coherence in policy that in the end leads to these issues. Why a state cancels projects, why some states back down renewable, the first thing any problem arrives is because first, there is no penalty hanging on them. Second, there is no legislation that they have to follow. Every state in its own mind is building renewable however much they want to. Are they looking at transmission? Are they looking at the tariff? I don't think so. So I think if I have to sum up overall what the next step the center should do is to come out with a framework that covers everything from generation, transmission to distribution of renewables, and not just talk about gigawatts. I think the sector is so mature right now in this country, with so much $1 billion riding on it, as Amit also mentioned, that we need to go into the nuances now. We need to talk about the tariff. We need to talk about the components of tariff. We have been pushing for manufacturing, but is it successful? We one fine day we just wake up and decide ki it should be all local manufacturing, but is it feasible? Is it feasible for a project developer right now? So I think in terms of policy, as you mentioned, that is something we should do, and in that I believe the center should have an active dialogue with the states and build a policy that suits all. It is difficult to do a country like India, but something, there should be a touchstone that the developers and the investors can go back to. So that's it.
I think, Shreya, you've done a really good job of laying out, like an overall plan. And actually, I'm going to give the hard job to Sandy to reflect on some of those remarks. Particularly Sandy, Shreya, I think one of the most interesting things that she said among her many remarks was lack of clarity and coherence. And she also talked about policy uncertainty. She mentioned a bunch of things, including the import duties, etc. So from your perspective as an investor, what is your, as an international IPP investing in India, what is your outlook on this lack of clarity and coherence and also policy uncertainty? So maybe your thoughts on those.
Sure. In fact, Shreya's brought up very pertinent points, and completely agree that, see, as global developers or investors, what we look for is a stable, consistent, and long-term policy certainty, and a conducive regulatory environment, so that in the markets we have a certainty of cash flows, and our investments, once made, are not subject to risks which can't be either planned for earlier, or can't be mitigated, or can't be priced in. I mean, we're not looking at fixed deposit, no risk investments. We are here to take risks and earn our bread and butter, but there's certain risks which we can't price or even fathom. So those unknowns should be taken out of the equation, right? So therefore, while absolutely right, Abhishek mentioned earlier that the government, the central government in its intent was very supportive during the COVID times especially, and that gave a lot of comfort to us as developers. In fact, the depth and frequency of engagement with the central government itself and MNRE itself was very comforting in those trying times when there was pain and nuisance all around. So that aside, I think what's most important for us as developers is to have a very clear and stable regulatory framework consistent with the energy targets we have in mind, and a greater transparency on tender planning. I mean, have a clear window of when the projects will come in. I mean, it's not necessarily we hit the 450 gigawatt target, but whatever we hit is big enough. The pie is huge enough for everyone, even from here on. So the release of a mid to a long-term plan of upcoming tenders, including schedules, technology capacity, will allow us to size our pipeline better, plan our resources better, and also have our development activities done in advance, which also means this requires better coordination between the center and the states, which is the biggest challenge right now. With the center is very keen, completely supportive, but there is a perceived lack of kind of alignment between the center and the states and other government agencies in terms of the development plan. So, which includes also on land acquisitions, support on right of way, and also the necessary transmission network capacity augmentation, having an overall structured development strategy, as Shreya talked about, to efficiently integrate the RES. So that's one thing. And then I guess in this backdrop, the amendments proposed in the Electricity Act, including the creation of the enforcement authority and other the other talks about must run, etc., which will come in. If it comes in the Act amendment, will give more teeth, more legal teeth or authenticity. One aspect which is very, very important is the reforms in the distribution segment that we talked about. I mean, the financial health of discoms has been a challenge, and we've all talked about this. I think the discoms have gotten used to this periodic bailout packages, and I think for one, this band-aid approach has to stop. It has to be, as again quoting the Honorable Prime Minister, reform, perform, and transform. I think the time has come for them to kind of do that, or get the clear message that either they reform or perish, because it is time to improve, bring in operational and financial efficiencies into the distribution sector for a sustained kind of growth. And in this regard, again, I guess reforms or privatization could be the way forward, or at least bring in some semblance of bringing cost-effective tariffs or regular tariff increases as required. And one element that probably has not been talked about too much is the debt financing to boost the sector, because while we're talking about equity returns, 70-75% of the cost of the project is borne by debt, and the cost of debt becomes a significant element. And the banks in India, given that the short-term deposits lead to an asset liability mismatch, the banks are full with their power sector limits, so the exposures are their ability to lend to the sector is limited. It's only NBFCs and private sector banks who are participating in the funding, and their costs are higher. And of course, the rates are floating, and whereas the revenue profile is fixed. So these things have to be looked at. Maybe it's time to deepen the corporate bond market, or look at innovative solutions to have rate enhanced bonds, as we looked at NL globally as well. So those are some of the elements that I would look at to bring in the reforms.
Okay, thanks for that, Sandy. Maybe I'll come back to you again to hold that thought, and especially the solutions, because that is essentially what we're interested in. But I think we can also take an interesting question that we have from the Q&A section, and Parag, maybe you can come in on this. So, of course, a lot of the panelists have talked about the discoms' financial health and the need for maybe more competitive tariffs. But on the flip side, there's often a criticism that the Indian sector is often focused on lowest cost in terms of tariffs, rather than technologically better solutions or sustainable projects. So, I mean, as a developer, Parag, in terms of what is your take on this, right? Is the L1 obsession something that is necessarily going to drive capacity deployment, or do we need to take a step back and also consider other factors? So just touching upon an interesting point raised in our Q&A.
Yeah, so Arjun, before I just reply to that specific question of yours, just one minor clarification or minor point from my side. If we see, it's not because of COVID that we have 18 to 20 gigawatt of unsigned PPAs pending with SECI. The reason is not that, and reason is neither the lack of demand. I think we need to understand the reason is because Indian government wanted to have a successful manufacturing bid, and this 292 tariff, which is 12 gigawatt out of this unsigned 18 to 20 gigawatt, that is which is leading to delay in signing the PPAs. In fact, demand has now risen in October by 14%. The only implication of COVID in this year is that projects have been pushed out by 4 to 5 months. So that is something which I thought I should just comment on, which was discussed just now. Coming to your point, Arjun, that are we really bidding a number which is not easy to execute? I don't think so. So I think the industry is mature enough. In fact, government at one point introduced a mechanism from last 2-3 bids. Then the price difference between L1 and the highest bidder should not be beyond a gap of 3%. So that was but that was never used. And that shows the maturity level in the solar sector in India. Most of the bids are getting closed within the gap of 2 or 3 paisa. So when 5 or 6 people or an entire 2 gigawatt of capacity bid out is getting close within a gap of 2 to 3 paisa, it shows that no one player is going out of the aggression and bidding very aggressive number. So that's the point I would like to make. As far as technology innovation is concerned, I can understand that in India, we have not started using bifacial and tracker in as much prominence as that is being used in Middle East and other countries. But that is for a certain reasons. It is not working out in India. We don't have an albedo meter, which is measuring more than 30%. So there are reasons for that. We tried in the past trackers. So in a way, we have moved to 1500 volt system, which is really viable. So whatever is the technical innovations which were possible to bring down the tariffs, that has been very wisely accepted by the solar industry, but we haven't gone with the bandwagon of whatever is happening globally. Let's use trackers. It doesn't work in India, we don't use it. Let's use bifacial and trackers. It's not working out by now, so we are not using it. But other than this, we have been using all the resources that we have today to bring down the tariff.
Thanks for that, Parag. We have another maybe 5 minutes before we start to round things off. So, Amit, I'm going to come to you again. You're the one who started us down this exciting path of, back and forth and interesting conversation. I'm going to put you on the spot a little bit and also signal to Abhishek and Shreya to also be ready. I want you to give me maybe your top 3 solutions, right, in terms of intervention that are needed to set India on a path to 450 gigawatt by 2030 from the existing path where, let's say, we are on the consensus that we may not necessarily be reaching there, right, unless we intervene. So top 3 solutions.
Arjun, I thought you will not come back to me since I put you in stop in the first instance, but it's okay. I think you're trying to do a tit for tat. I will take it in a complimentary way. So to answer your question, let's identify the 3 risks, 3 key risks, which could be the solutions. First, I agree with Parag. See, that's an old story. If a 2.5 work or 2.7 works, 50% equity RR everybody is making. So market is now mature enough. That story is now over. The off-taker risk remain. That discoms are in bad health. This is for post-implementation, right? Curtailment or delayed payments. That risk remain, which where I said Reva Solar Park gives a very good story, where a 3-tier framework of letter of credit, a escrow account, a funded escrow account of 6 to 9 months, and a guarantee. It could be a government of India guarantee, a state government guarantee, a World Bank or ADB guarantee, which this is the gold standard guarantee. If everything fails, the investor knows, okay, government of India, World Bank or ADB is going to pay me, and this is a perception. Usually those guarantees are not encashed, it's like a perception which gives comforts to the investors. The second biggest risk is renege of PPAs. Unfortunately, I don't have an answer for that unless, Arjun, you decide to change the Constitution of India, which I believe with IEA and CW, maybe we can make it happen. But because electricity isn't a concurrent subject, if Andhra Pradesh or Tamil Nadu tomorrow wants to say that this 100 rupee note is not 100 rupee, I'll give only 50 rupees. I don't know what to do of that, right? So if you start renegotiating the existing contracts, unless we change this concurrent subject of the electricity. Finally, the biggest concern which I highlighted is the PSA, because till India has been telling a very mature and positive story and vision and a roadmap to the whole globe that you come to India and then we will make sure that you will get a scale, a gigawatt scale for next 5 to 10 years. That's the story we have been telling. With reverse auction, this story has been going very well. But what happens in the last 1 year is disturbs me, because when you give an auction and you go to the whole world and say, oh, we have done a great job in 2.5, 2.7, and we are moving ahead by sanctioning projects, but we don't implement those projects, what happens wrong, Arjun, is that the sovereign wealth funds, the private equity, they have the money stuck where they were planning to invest $5 to $10 billion, and now they are stuck for 1 year, 2 year, or 3 year. How do they invest the problem? That's where I propose a really innovative solution of bundling. Arjun, what's happening is discoms are getting confused. Discoms are saying, I get today 2.7. If I wait for 6 months, I get 2.5. Maybe I'll get 2.4. When 2.5 comes, 2.7 becomes more expensive, right? And every state has a different appetite. Every state has a different politics. What I'm trying to say is, if Government of India says auction will happen, 2.5, 2.4 will come, but that's for the Government of India. For the discom, I will give you a standard PPA, a standard number. I will mix these PPAs internally, bundle this up, either only the solar or wind PPAs, or I will bundle with coal or thermal. But discoms, you will get one PPA from our side. Doesn't matter state or center. Number could be 2.6, 2.7. What happens then? Discoms doesn't have a choice, doesn't have a confusion. This is a solution which we can implement today. That's why I feel this short-term to medium-term problem of these unsanctioned or PPAs which has not been signed could be solved by bundling.
Okay. Thank you, Amit. So very quickly coming to Abhishek and Shreya, maybe 1 minute each, guys. Give me your top 3 solutions or interventions to unlock greater capital flows for India in the RE sector.
Maybe Shreya, with your permission, I can go first. So I quite like Amit's view about the common PPA that can be given to state discoms and a central government utility standing behind as a face of the government in front of developers. So that's quite nice, nice and well thought out, I think, and that should be looked at. But the couple of solutions from my side, I mean, we've talked ample amount about the off-taker risk and the payment delay risk, etc. There is a fair amount of risk that the investors are facing on the execution side as well. And while on one hand, the government is gunning on, bidding out projects one after the other, I think there's a need to step back and to understand that where all the projects that have been given out in the last 6 months to 1 year, where those are and how can the government agencies get together to resolve those issues. You know, there have been issues around land acquisition, there have been issues around evacuation, signing of PPAs, etc., etc. And how can those execution challenges be taken care of in a similar zeal with which new PPAs are brought out and bid out. Okay, so that's that. And the second one I would say is the provisions of the Electricity Amendment Bill. They talk about a number of important things which the government has thought about and they have been brought out. However, nothing has progressed since the amendment bill was drafted. And I think the passage of that bill would give a lot of comfort to the developers as well as to all the stakeholders in the power sector. So those are the couple of things that I would recommend.
Okay, thank you. Shreya, your top 2 or 3 solutions.
Yes, very quickly. One is the operational efficiency of discoms. I think it's high time a lot of private investment comes in that. Be it privatization, franchisee, technology partnership, doesn't matter. Discoms need to come out of the 18th century operations that they are into. Second, somebody should really think about grid and transmission. No one's talking about it. And I guess the pace at which we are building green energy, the grid really needs to be prepared for that. And third and most importantly, somebody get wind energy out of oblivion. With every policy, every discussion that happens tends to focus on solar. Wind is like this forgotten child. I think we need to keep in mind wind as well. And as Amit also mentioned, we need to focus on hybrid projects. I think that's the future, hybrid. Yeah. So these 3.
I think thank you very much to all the panelists. I think we had much jousting and jostling, and I enjoyed that very much. So I'm going to give the hard task again to Michael Waldron and Kanika Chawla. be architects of the Clean Energy Investment Trend Series to reflect upon today's proceedings and to close off the session. Mike, over to you.
Thank you very much, Arjun. And first, just congratulations to yourself, to Lucila and Pablo for a very insightful report. You guys have shed light on which is a very difficult issue to measure and understand, is what are the financing costs, what are the risk-adjusted returns, which are shaping investment decisions in India's renewable sector today. So congratulations on a job well done. I think we've heard from the presentation and also from the very fascinating panel discussion a range of views of the state of the investment landscape in India's renewable sector, ranging from resilience to, I heard the word shock at one point as a result of the pandemic and the ongoing risks. So there's a lot of gray area, or there's a lot of uncertainty as to how things really stand right now and what's going to happen, what's going to play out over the next 6 months, 24 months, et cetera. On the positive side, I mean, I've heard some good things about India, and we consider India to be a success story in terms of attracting investment in renewables, particularly in solar PV. It's made a huge amount of progress over the past decade. The market is mature. It's attracted a degree of scale in terms of the project size, in terms of the amounts of investments, which far eclipses many other markets in the world. And we have also seen a healthy degree of competition brought about by the tender system, by the strong policy framework over the years, which has essentially created an industry and created a sector which did not exist there just a decade ago. And let's not forget the opportunity for renewables, both in India and other parts of the world. In India, project costs are extremely low. I think they're among the lowest in the world, which we didn't discuss very much. And so really the key is bringing down those risks and bringing down the financing costs, which is creating sort of sticky upward pressure on returns, but also in terms of the costs, the purchase costs that are being faced by discoms. So that kind of brings me more to the uncertainty or the negative side of the equation. And I'm really struck by the report and really struck by the discussion of the amount of sensitivity that we've observed in these expectations for equity IRRs around changes in competition on a year-to-year basis. These changes are occurring because of uncertainties coming out of the policy making environment, but also because of the conditions brought about by the pandemic. Counterparties remain crucial nodes in terms of determining the risks and the risk-adjusted returns facing developers. And while we have heard some good positive news about steps to assure bankability in certain cases, the involvement of the central government in offtake, and also some of the performance of the better states, there's still a lot of ground to be made up in terms of improving discom health and in terms of actually bringing PPAs to market and getting them signed in a timely and reliable manner. And then also, of course, the issues related to infrastructure, to land. We heard risks related to the operation and the execution of projects. These are all persistent and have the potential to worsen in the current environment in India. So we heard a range of solutions, and I'll try to conclude by trying to sum up some of the solutions that we heard from our panelists, which are all excellent. A number of these were kind of more on the innovative side. So in terms of project structuring, in terms of the new types of tenders that we're seeing, hybrid projects, bundling power, combining land, infrastructure, and guarantees to mitigate or to address risks. But I also heard a lot on a need to focus on the fundamentals, and these fundamentals involve basic enforcement of contracts. They involve the entire health of the distribution sector, which is fundamental, but I wouldn't say it's a simple thing to tackle. And it also implies looking more holistically at system-wide power planning to include the grid, to include financial markets, the involvement of the corporate bond market. One of our panelists said we didn't speak so much about debt today, but we have seen debt costs for renewables come down in many parts of the world, but we haven't seen them come down in India. So accommodative monetary policy hasn't necessarily translated into lower debt costs. And then, of course, we only heard it at the very end with the wind sector, which seems to be a bit neglected in the debate, but is still very important. And on a global scale, is one of the largest wind markets in the world. So the solutions, I think, give us a lot of food for thought in terms of how to take this joint work forward. But it's clear that the assessments that we've made here are just going to get more complex. And so that the tools that we'll need to refine over time to assess this market will depend in part on working with industry folks like yourselves, but also policymakers more closely. And with that, I will turn it over to Kanika for the final remarks.
Thank you very much, Mike. What a rich discussion this has been. I want to thank everyone who has participated in this discussion. Thank you to Arunava and Tim for kicking us off, to Arjun, Pablo, and Lucilla for just this outstanding analysis that you have all put out, especially in a difficult year where it's hard to make the difference between what is an anomaly and what is a trend. And I think that that's kind of why this year, this analysis is more critical than it has been in previous years, and it gets better and better. So many congratulations to all three of you, to all of the speakers today who have been extremely candid. I think the notable mention must go to my friend Amit, who can always be relied on for stirring the pot and getting the conversation going. But really to all of you, Sandy, and I know Parag had to leave us, but for really, I think, continuing to have faith in a sector that isn't always looking exciting, but broadly you're sort of, you see the vision, you're not looking at it myopically. Abhishek for kind of being a realist, but also, putting your money where your mouth is. Shreya for being, as we've been saying, for doing such an outstanding job of reducing some of the information symmetry that this sector faces. And I think that kind of comes down to what this collaboration between the IEA and CEW is built on. And I think it's our shared ideology of following the evidence, especially in a sector which is changing week on week and day on day because it's so exciting and it's so new. Especially when we got started with this work a couple of years ago, you could have 100% capacity increase in just 1 year because of the small base, right? And then to the point where we're at now, where we're one of the largest markets in the world, I think that it's important to kind of parse through what is anecdotal evidence and what is the real evidence. And I think that is why I'm very proud of the work that we do together. We've had some outstanding questions being asked in the Q&A box, and some of them have not been answered, and we will get back to you with written responses. But also to everybody who's participated in today's webinar, thank you very much for listening to us. I would strongly encourage you to please look at the report and the webpage for it. A lot of effort has gone into it, but that's not the only reason you should look at it. You should look at it because I think you'll have a new, fresh, and a very clear perspective of where India's renewable energy markets are headed. So with that, I want to once again, on behalf of all of our collaborators at the IEA as well as the entire team at CEW as well as CEWSF, thank you for joining us.
Thank you very much.
Thanks. Bye.